everyone, and welcome to a very helpful, albeit brief seminar on cash flow. Today, we are going to talk about what cash flow is and what cash flow is not. And we are also going to talk about the difference between cash flow and profit. And we're going to talk about how to maximize your cash flow and what to do when your cash flow leaves you in a bit of a deficit. So there are lots of things that we're going to cover. We're going to give it just one more minute to see if anyone else wants to join us today. We will have time for questions at the end of today's presentation, but you should be seeing my screen right now. It says Cash Flow Bootcamp presented by ProfitSolve. You are in this presentation because you're looking at one of the solutions that we have here in ProfitSolve, and specifically you're looking at a solution called TimeSolve. So we're going to talk about that in conjunction with today's presentation, but really we're going to focus specifically on cash flow. All right, so we are about 1 minute past when we would typically start, so let's just jump right into it. So my name's Joyce. I am a lawyer. I'm licensed in North Carolina. I have been in practice management and legal technology since 2011. I've worked as a practice management advisor. I've worked in legal tech sales. I've managed folks. I've done a lot of consulting for non-lawyers on how to understand lawyer business issues, legal business ethics, legal trust accounting, and I have presented to, at this point, thousands of lawyers and law firms to help them understand how to implement technology in their business. So that's who I am. So I hope that that gives you a little bit of peace of mind when I'm giving you some advice here, or at least sharing some of the good, beneficial things that I have learned over the past several years since 2011, since I've been doing this. So let's talk about what cash flow is in today's presentation. We're going to talk about understanding exactly how much money you have. We're going to talk about what happens if you don't have enough cash flow and recognizing that. We're going to talk about the solutions built into your legal technology, your practice management, your time and billing software that can help you manage cash flow issues. And we're also going to talk about what you can do with your bank. So cash flow issues aren't all going to be resolved by technology. There's some things that it really is helpful to have some tools from your bank, or some areas where it's helpful to have tools from your bank. But let's talk about it. Let's talk about understanding the issue. Let's talk about how we can always pay our bills on time and how we can manage the cyclical issues that are involved with running a law firm. All right, so first and foremost, what is cash flow? Let's provide some definitions and examples. Cash flow. Smallest, easiest way to describe cash flow is your total liquid assets being moved in and out of your bank accounts. Cash flow is not just the money that's coming into you. It is not your profit. It is how money comes in and how money leaves. You can define money as a particular currency. You can define that as Bitcoin or some other blockchain secured currency. It does not have to be US dollars or any particular type of currency, but we are talking about liquid assets. That is what we mean. In today's presentation, we're going to be talking about operational cash flow. There are some other types of cash flow where our investments might create some returns that are automatically deposited into an account for us. That's not what we're worried about. Today, we are focused on only operational cash flow. All right. So in order to do a cash flow analysis, we need to review the money that has been brought in or that we've received and spent over a certain period of time. I want to take a moment to pause right here. Just because you are owed money does not mean you should include it in your cash flow analysis. There is a difference between accounts receivable and money that has been received, fees that have been earned, or money that you've gotten some other way, right? Cash flow is only about the money that has been put in a liquid form that has either been deposited into an account that you have access to, or you have moved out of an account to pay another bill or for some other reason, right? It's liquid assets in and out of your account. It's not hypothetical money that should be spent on your fees or hypothetical money that someone else should give to you. It's what has actually come into your account. So we need to look at your balances over a certain time period. An easy way to do this is just look at the past month. It's important to look at this on a quarterly and annual basis too, because there are some large expenditures that happen every now and then, but it's important to just start with a manageable piece of time, right? So when we look at what you have, so you've brought in a new client. I've got a typo there, guys. I'm so sorry about that. But you've brought in a new client, but have they paid you? If they've paid you, count it in your cash flow. If they haven't, do not count it in your cash flow. You have money owed by clients, but is it collectible? I don't know, but we can find out. Once you collect it, we can count it. And how much money do you need on hand to pay your bills today, tomorrow, at the beginning or the end of the month? When must you pay your bills? Now, sometimes this can be a little elastic, but we really should consider the actual due date for when our accounts payable are due so we can actually stay on top of things and potentially get ahead of them. All right, so let's talk about this a little bit more in depth. Cash flow analysis. How has your operating balance changed over the last month, over the last 3 months, over the last year? So let's define money earned. And we've hinted at this, right? Money earned, fees earned after completing work for a client. That is very clearly fees earned. You've done the work for your client, you've received the funds, that's your money, right? There's not a bar association in the country that would disagree with that. Contingency fees, when a case is settled, you've collected those. You've gotten a settlement from an insurance company, whatever it happens to be, and you have actually taken your percentage out of it. Those contingency fees that have then been paid to you, that's very clearly yours. Fees that are defined as earned at the beginning of representation. Now, you might have a fee agreement. You might be one of those lawyers who says, I don't want a trust account. But I do want to take money from clients up front. Now, I think that that's a pretty bold stance to take. It's not how I would run things if I were your bookkeeper, but if that's how you're running it, that's fine. I would be cautious about it, but if your fee agreement is very clearly, if it states that and you're comfortable with that, then you can include those fees that have been received at the beginning of representation as fees earned, but very clearly retainers, right? And just make sure that you understand the difference between retainers and fees collected at the beginning of representation. They are not the same thing. Please don't confuse them when you're talking about accounts receivable, when you're talking about money that should be held in trust that is not actually yours yet, versus money that's in your operating account that is part of your operating cash flow analysis, right? So we have our money earned. Let's look at our money collected, money deposited into your accounts via credit card payment that just magically appear there by virtue of electronic payment systems. Cash deposits, clearly that's money that has been collected and is in your bank account. And of course, clear checks. Someone pays you by check, digital check, wire, an actual paper check that you've deposited. That's all money collected, right? So not all money earned is going to be in your cash flow analysis right away. But if you've earned it and you've collected it, it should be included in your cash flow, right? So let's think about this for a minute and we look at a sample cash flow. And we talk about green, these little green bars here as the money in our operating account, and blue is our accounts payable balance due. Now I'm looking at a typical small law firm that has somewhere in the neighborhood of $25,000 in their operating account. How much money do they need in their operating account on a regular basis? This is where we find the difference between profitability and cash flow and how lawyers get in trouble. It's in the middle of the month when we know we're profitable. We know we're profitable. We know we have money coming in. We're going to bill next week, but I have more accounts payable than I have in my operating right now. There's a deficit. There's a deficit. What am I going to do to cover that? So you see my green bars dwindle right until the end of the month when I start collecting, right? And my blue bars consistent, and then a shot up 1 week. That's payroll week. What do I do to cover that? So let's look into this, dig into these a little bit deeper so we can truly understand what we're talking about. So on January 1, I don't have any accounts receivable collected for this month on January 1. If I did, I'm really doing great, right? Accounts payable due, I have $10,000 that's due. That's my rent, that's my insurance, that's on my actual property. That's going to be my lawyer's mutual payment, my liability insurance, right? Maybe it's cyber insurance, whatever it happens to be. I've got $10,000 that's due, just standard operating. Cash on hand, $15,000. Okay, that's cool. I've got on January 7th, $1,500 collected. I've got AP due of $2,000. I've got cash on hand, still $15,000. All right. Maybe I haven't paid that bill yet, right? On January 14th, I've got $1,000 collected. I've got additional 500 due, cash on hand 1550, right? January 21st, I have only 500 collected. My accounts payable that are due $17,500. I've got to pay payroll. I've got to pay Social Security insurance. I've got to pay unemployment insurance. I've got to pay into benefits. I'm paying myself and 2 legal assistants, or myself and my paralegal. All of a sudden, I've pushed things off as far as I can. Now my cash on hand is negative $1,500. What on earth am I going to do? But January 28th, all of a sudden I've collected $18,000. I've run my invoices. People have paid me, and now I have $16,500 on hand. I can pay everything that's due this month. But what I did was I did not have enough cash on hand. Ultimately, at the end of this month, it's a profitable month. It is a profitable month. However, I am not going to be able to, or I have more cash on hand and more AR collected than I have accounts payable, but I did not have it at the right time. So what am I going to do that, to manage this process? How am I going to manage negative cash flow for my business? And I want you to understand, folks, having negative cash flow is not a bad thing. It's not your fault. That's just the nature of our business. It is cyclical. It is absolutely cyclical. Money comes in at different times. We get paid at different times. Our accounts payable are due at different times. So it is just entirely possible that we are going to have negative cash flow. So understanding how to level our cash flow, creating more reliable cash on hand, and eliminating negative balances is a critical part of how we're going to run our businesses, right? So tools available right now to manage negative cash flow. First of all, you need to understand the risks. And this is going to be divided into 2 categories when you look at your cash, right? When will I be paid, and when do I need to pay bills, right? So how can we make sure that we have more cash on hand when we need it? Firstly, to manage this when will we get paid category, you need always, if possible, to get paid at the beginning of service. You might not feel comfortable putting that money in your operating balance. I totally understand that. You might want to hold on to it and classify it as an operating retainer. You might want to hold on to it in trust and bill against it periodically as part of a payment plan. That is completely acceptable, but get money up front so you have it. Of course, you cannot put money in there until you have defined that money as specified in your fee agreement as earned, right? It has to be earned under the very explicit terms in your fee agreement, but have money that you can bill against so you're not waiting for someone to give you money when you need to bill, right? You need to get your payment method on file as soon as someone becomes a client of yours. You need fee agreements that include payment plans. Now, this is something that not all lawyers are comfortable with, and not everybody has taken a liking to so far. Folks like to bill on just a regular basis, but maybe don't have a specific payment plan in place for their clients. They say, well, I'll just bill you once every 3 months, once every 2 months, I'll bill you periodically. That's a great way to lose track of exactly how much someone owes you. It is a great way to not get paid on a regular basis, right? So billing on a regular basis on a payment plan against a payment methodology that you have on file is the right way to do this, okay? So get your payment method on file. If possible, bill at the beginning of service. Have fee agreements that include payment plans for larger payments, especially for clients that don't have enough money to pay you up front, and have a standardized billing week, or at least a standardized billing process, so clients know when you are going to bill them and they can prepare for that, right? If they are prepared and you give them notice, they are much more likely to pay you on a regular basis. So then after we have done the things we need to do to successfully get paid faster, and we'll talk about how you can do some of this within your practice management solution. Let's talk about when you need to actually pay your bills. So if you know that a huge portion of your bills are due 2 weeks before you have your billing week in your law firm, and it's constantly creating a negative cash flow scenario with you, call your creditors. Call your bank, call your credit card company, call whomever you need to call and say, is it possible to work on a different date? At least short term. Maybe it will work for you and maybe it won't, but it is possible that they would be willing to move the date for you. They want to be paid. They don't want you to have a negative balance. They don't want you to go to another service provider because you didn't get the service that you were expecting from them. So give them an opportunity to make it easier for you to run your business. That's how they create long-term happy clients, right? If possible, get in front of your bills and pay early. So part of this cash flow analysis is understanding exactly how much you need to pay every month. And it's shocking to me how many folks don't actually budget. They think, oh, well, I've got enough and I'm not exactly sure how much I'm going to spend on office supplies this week. I'm not exactly sure how much the janitorial bill is going to be. I'm not, I know generally what my rent is, but I'm not sure down to the penny, right? You need to know, you need to be really sure, and you need to know when it's going to come in. So when you have that big balloon payment at the end of the month, the beginning of the month, or whenever you're running your bills, you immediately put that money aside, right? Get in front of your bills if you can. Please get in front of your bills if you can. If you can't, you have a couple of really good options from your bank. I would love for you to reach out to your banker today to talk about lines of credit. If you have a business in the US and you do not have a line of credit account, you are doing yourself a disservice. You may never use it, and that's totally fine, but you need to have it. So a line of credit is different than a credit card. You cannot pay bills from a line of credit, but you can transfer money from a line of credit to another one of your accounts within that same bank, and it will help you cover your shortfalls. You can set it up to default to automatically cover any defaults in your account. There are some really fantastic ways to make sure you're covering any losses, any shortcomings, any negative balances that you have. A line of credit is a great way to do that. They typically have very reasonable uh, interest rates. And if you're just managing shortfalls over a week, you can pay it back within the same month and not incur any interest payments or any interest fees. So please look into lines of credit and talk to your banker about flexible business cards from your bank. You're looking for something where you can set the payment date when you want to set it. You're also looking for something that has flexible spending limits that's going to work with you and what you need. But at the very least, talk to your banker. Okay, those are the things you need to do. So let's talk about the tools within your legal software that you need to be using right now. I specifically want to talk to you about TimeSolve, but there are solutions in a variety of softwares provided by ProfitSolve, which is the larger family of brands that TimeSolve is in. But in TimeSolve, let's talk about this because TimeSolve is spectacular software for managing cash flow, right? Payments built into your service. You already have a credit card processor built into your service right now. It is fully integrated. You can put a link in all of your invoices so your clients can pay you today, right? You're also going to be able to capitalize on extremely low interest rates. Now, please keep in mind the difference between an advertised credit card processing rate and an actual credit card processing rate. There is a huge difference, and read the fine print if you're out there looking at other solutions. What you might find is a really low advertised rate, but when you click around on a website, you'll see things like pass-through fees or specialty cards fees or bonus card fees, whatever it happens to be. You want to avoid those because it makes it unpredictable. It's hard to create a standardized billing rate or a standardized billing practice that accounts for that fee when it's so variable. What is a lot more beneficial for you, especially when managing cash flow, is a predictable rate. And that is one of the reasons I absolutely adore the integrated credit card processor within TimeSolve. It is a flat rate across Visa, MasterCard. It's a standardized rate across American Express. You're not going to get variable rates across different American Express cards. It's going to have a standardized per transaction fee, and it's going to be one of the best, if not the best in the industry. So you're going to save money, you're going to standardize your rates, you're going to understand how to budget, and it's going to be fully built into your solution. So why does that matter? Oh, you know what? Let me not forget next day funding. So again, we're talking about cash flow and cash flow analysis. Collecting that money is really different than having that money actually deposited into your account. So yes, they've clicked the link to pay it, but if it takes, 5 or 6 days for that money to show up in your account, that's a shortfall that you have to cover somehow, right? Again, amazing solution within TimeSolve is that they've got next day funding. So someone pays on an invoice that you send to them, the very next day, that money is in your bank account. It's incredible. So let's talk about some of the other things that you can do and why an integrated solution like this matters. Again, you want to set up payment plans and you want to set up recurring payments. Payment plans for anyone that has an outstanding accounts receivable balance with you. They need to know what they're going to be charged, when they're going to be charged. You need to have a credit card on file, and that needs to hit like clockwork over and over and over again until that AR balance for that particular client is zero. That is what you need to do. And then you need to set up recurring payments for anyone who's a current client that is on an ongoing payment plan with you while they have an open matter. So these need to be applied to closed matters where you have an open balance, and open matters where you have an open balance that you might actually continue to charge against, right? You need to have payment methodology on file. You need to bill regularly. Both of those things can be done within TimeSolve. I mean, you can click just a few buttons and within a matter of minutes, send invoices to everyone who has an open account or an open balance with you in TimeSolve. Literally a matter of minutes, you can get that done with a link so someone can pay. The whole goal is to get you to zero AR right now. If we can get you to zero AR, we can probably manage your cash flow issues much, much easier. So it is important. Use the integrated payment processor to limit the actual cost for the solution. Use the credit card processor to minimize the time between money being marked as paid and invoice being marked as paid and when it actually hits your account. And use that processor to set up recurring payments and payment plans. Okay, so again, let's talk about tools from your banker. We mentioned this before, but I want to mention it again. Get a business credit card if you don't have one right now. I do not advise maxing out business credit cards. I don't think anyone could do that with a good conscience, but they are helpful sometimes, especially if you are managing a income shortfall over a finite period of time, right? The whole goal is to not put more in your credit card than you can pay off within the next 30 days. Sometimes that happens, but the whole goal is to pay it off and pay it down and never incur any interest, if at all possible. Of course, the bankers are hoping that you will, because that's how banks make a significant portion of money, but they are very happy to issue you a credit card. Look for low rates, flexibility on the due date, and flexible limits, right? Lines of credit. This is something, again, everyone should have. If you don't have one set up, you can call your bank today and get one set up. Make sure you understand the terms on your lines of credit, including your total interest rate. And again, it's very, very much like a credit card, but you cannot pay bills directly from it. That is high level cash flow, folks. How much money is coming in, how much money is going out, when are you getting paid versus when your bills are due, and how do you cover shortfalls? The answer here: integrated payment processors in a solution like TimeSolve, business credit cards where necessary, and definitely a line of credit to cover any finite shortfalls that you have. That's it. I'm going to go ahead and pause the recording now.